right now, we are officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the man that I call GC, because he's got the genius concepts, because he knows how to generate cash flows, because he's a great co-host, because he's getting close to 40, and because his name is Gregg Cohen. Say hello, Greg.
I like that one. Getting close to 40. I like that one. I am 1 year away. So thank you for reminding me, Pablo.
GC, getting close, buddy. It's all about that big milestone coming up. And like we like to say here on the show, if you have come to find out how to own rental properties in your portfolio, you're in the right place. If you come to find out about best property management practices for rental property investors, you're in the right place. And if you've come to get an edge specifically today on the Jacksonville market, really understand what's going on, the opportunities that exist in the Jacksonville real estate market, you're in the right place. Next place to go is chat with JWB.com to get a custom strategy. And right now, something special is happening. We're about to do a very special roll call today. You see Gregg's face. I'm going to get into the roll call right now, and then we're going to explain what's going on. Happy birthday to you. Go. It's a special happy birthday roll call. Awesome. John Henry, good afternoon. Lee Bishop, Bon Après-Midi, good afternoon, everybody.
Goodness.
Nadeem Shah with a good morning, good afternoon. Jen Filson with a happy birthday, Gregg. We got Lee Bishop with a birthday boy spending time with us. Nadeem, all right, everybody's wishing him a happy birthday. I'm losing track.
I'm just joking.
Gregg, what happened there?
I don't know. Could you guys see that? My team just ambushed me with birthday wishes. It's pretty incredible. The studio is not that large. So we had like standing room, people were piling in there, and multiple cakes. We have multiple November 23rd birthdays here on the team today. You guys, all of you, thank you to my team. Thank you to you guys. Pablo, thank you guys for making me feel special here.
I was calling out, man. It's great to be able to celebrate with you, man. We got something special here, right? Everybody's pumped up, wishing you a happy birthday. I said a couple people during the roll call while you were getting serenaded. We got Nadeem in the house, we got Lydia in the house, we got Eileen Mateos, we got Anthony Ditta, we got Peter James, we got Jen Filson, the fairy godmother of the Not Your Average Investors community. We got Lee Bishop, of course, the MVP of the community, and Drew Barnhill joining us from Atlanta. Drew Barnhill is here as well. Who else we got? All right. I'm rolling up on everybody noticing what was going on. Marilyn Cotterman from Homosassa, Florida.
Home of the Manatees.
Home of the Manatees. Hervé Francois from the Dirty Jers. He's saying hello. Fatima Lopez is in the house saying happy birthday, GC. Who else we got in here as I scroll up this chat? Jay Cohen wishing you a happy birthday.
Pops.
He's an influential guy in your life.
Pops. Can't wait to see my dad. He's coming up here a little bit. He's coming up tomorrow to celebrate as well. So, Pops, thanks for tuning in, buddy.
Love it. Love it, Jay. Good to have you on board here. I've heard a lot about you. You're one of the reasons why Gregg is so into financial responsibility, from what I understand, and financial education. So it's great to have you in the house. Started with Pops. All right, GC. So that's the roll call. Everybody, you've been here. I see a lot of familiar names in the house, even though it's Thanksgiving week. Thank you for joining us. This is an interactive show. GC's got some hard-hitting data for you, and we are about to get into it. You ready, buddy? Oh, Danny Wang is in the house. He just joined us. Happy birthday, Gregg, he said.
Well, now I'm officially ready to get into it. Now
it's ready. Now it's ready. Yeah. It's man, you know what? It was kind of cool in here. And when we start the show, I start getting a little bit
It's not that type of show, Pablo. It's not that type of show, buddy.
I'm ready to put on it's your birthday. It's special. GC, what do you see when you Bill Shields with a Feliz Cumpleaños, Gregg. There you go. GC, before we pop open this data and this wonderful presentation that you put together for us, give me an overall kind of like sense of what's happening in the market and what we have to expect here on this report.
Well, the concepts that we have been talking about in the real estate world for the last year has been extreme lack of supply and heightened demand caused by population growth in places like Jacksonville, and also caused by historically low interest rates. And that burst onto the scene, call it a year and a half ago or so, and was just absolutely rapid hot fire in the real estate market to the tune of 15 to 20% home price appreciation year over year, absolutely breaking records of home price appreciation in a 1-year time period all across the board. And so what we are seeing now is those same concepts are still playing. In real estate, things don't change overnight. It takes a long time to build houses or create housing stock. And when lack of supply is the main driver of why you are seeing home prices increase, that's not going to be solved overnight. And so what we're going to look at today, that's still the underpinning of the marketplace here. We still have heightened demand. Now, at the same time, you can't be blistering at 15 to 20% home price appreciation for an extended period of time. That's not good for anybody to do that, right? And so what we're seeing is a slight softening of that ridiculously on fire real estate market, getting something that is getting a little bit closer to normal, but still well above historical averages as far as home price appreciation today. And I won't give too much of a spoiler, but why not? We're already here, right? You guys are going to see it in like 7 minutes anyways. But what we're going to see going forward in next year is that same concept is going to apply, right? It's going to take time to build enough inventory to get us out of this supply crunch. So you're still going to see home prices go up over the next year based on the data that we're going to look at here is my prediction.
All right. Well, let's make you prove it. Let's look at these numbers so that you can see what a liquid hot fire market looks like. All right, here we go. We got this thing. Gregg put it together. We're looking right now at the Jacksonville housing market pricing data. If you're listening to us on a podcast here in the near future, we're looking at a median sold price in Jacksonville, September 2019, $235,000. September 2020, $255,990. And September 2021, over 300,000, huge jump to 308,900. Gregg, what is that median sold price of a house? Like, what is that stat? How do we need to look at that statistic right now?
The median home sold price is the stat that you want to look at to measure your sales price in your market and also across the entire U.S. I use medians instead of averages because it's a better, more representative number to look at. And so when we think about September of 2019, before the world changed, we had a very strong market in Jacksonville. You'll even see some of the months of inventory data for September 2019. We had a strong market, and that also plays into the appreciation rate that we saw, the year over year appreciation rate of 4.57. That's a strong real estate market. To give some historical context, 4.3% per year was the historically accurate average appreciation rate in Jacksonville. And so when you see days on market, 43 days on market, that's very normal for a market, especially in September. Your appreciation about 4.6%. We were humming along a very, what we'll call strong real estate market, but also, a little bit, call it hotter than normal. But all things, kind of chugging along there like we would normally see. Come to September 2020, and that's when things were just starting to show as far as numbers in the real estate market that things were very, very different. $256,000 as a median home sales price represented an appreciation rate of just under 6%. And when you go from 4.6% to 5.8% year over year home price appreciation for the same month, that's a big jump. That's not normal, right? Your days on market of 34 days on market, that means the number of days from the time that somebody lists their house on the multiple listing service to the time that it is sold is starting to drop. So you're seeing all these indicators lead that you've got a really hot housing market. And then looking at September of 2021, oh my goodness, right? Nobody predicted this. We came out and we predicted that you would not see a decrease in home prices when coronavirus hit us and COVID-19 hit us, but nobody predicted home prices jumping 15 to 20% year over year. And that's what happened. A median home sales price of $309,000, median days on market of 15, scorching market there. and home price appreciation of 16.5%. Wow. The largest gains in Jacksonville and in many, many markets across the country and across the US on record.
Yeah, so major milestones here of having a median home price above $300,000 for the first time, right?
Absolutely.
And we mentioned the median price, right? You kind of went through the median days on market that just seemed to be, as the home price, the average home price goes up in bigger and bigger chunks, the days on market goes down in bigger and bigger chunks, and the appreciation rate goes up in enormously bigger chunks as it goes forward, showing essentially a market where supply is not there to serve the demand, right? Like, this is what happens when basic economics functions come into play. You start seeing this thing escalating. It's fair to say that in September 2020 to September 2021, a whole bunch of people wanted Jacksonville properties, and that's what drove the price up, right?
Yeah. And you had new demand from people moving here. You had you had new demand from people living here as well. And with the low interest rates, it is pulling demand from the future as well, right? People who are on the fence as far as buying a house in the next 3 years are like, oh my goodness, interest rates are this low, right? Let me buy a house today. So how much demand we're pulling from the future is an interesting question as well. But it is not certainly all demand purchasing or pulling from the future, because you look at the growth of population in cities like Jacksonville, and that's new demand, that's real demand. So, how much are we pulling from the future? It's an interesting question. There's really hard to get data on that, as you can imagine, but it's something that we're paying attention to as well. But right now, we have had low supply for a long time coming into 2019, which we'll show here in just a second. And then you just threw an insane amount of demand on it from population growth and low interest rates. And there's just no way for it to keep up. And when you have low supply, high demand, prices go up.
Got it. So this is the first time that you mentioned this pulling from the future kind of concept to me. And as I hear you explain it, that means to me, pulling from the future means someone like me, who had been living in Jacksonville and was deciding whether or not to buy a home, and maybe we're thinking 2 years down the line, decides to pull the trigger right now because I see prices going up, I see interest rates are still low, so I'm just like, whatever, man, I'm just going to go in. But also an investor like me, who may or may not be thinking, I'm going to have this much in my stock portfolio for a while, and I'm going to buy rental homes at this pace, decides, you know what, I'm going to get in right now, because the rate of return in the future, if I get in the future, is going to go down, whereas I can lock in this rate of return right now for an investment that I plan to hold for 20, 30 years at least. That's pulling future demand. Non-future demand is just people that moved here and are going to buy a house anyways, or you had a kid and you need a bigger house anyway, so you're gonna buy that thing, or the investor that had a plan already in place and was scheduled to buy homes in 2021 and then something else in 2022 and something in 2023, right? Is that how to think about it?
Yeah, you're right. And that pulling of future demand, if we're just talking about it as far as purchasing investment properties, I have been preaching pulling future demand in every single talk that we have had, right? Like, the idea that today your returns on investment are going to be better than they are tomorrow, and the idea that today you can lock in this low interest rate, you should be thinking within your own financial portfolio about pulling your future demand for rental properties to right now. And that's what everybody else has been doing as well. Some on the investment side, some on the big money side, which we're going to talk about on the call here as well. And then, of course, if you're separating that from like an owner occupant, that's also happening for, Sally, homeowner, who is thinking about, does she want a new house for her family today that she may have done, 2-3 years from now, if all things were, normal.
Got it. All right, GC. So let's go to this stat that we have discrete. And by the way, you're right. You've been calling for pulling future demand. Basically, you started going real hard at that maybe about a year ago. Like, I remember when we first started the show, you're like, you know what? this is just a good asset class. Then COVID hit. You weren't super sure what was going to happen. You just knew that prices weren't going to drop. And you kind of went out on a limb and said prices are not dropping despite what the news said. Then as we realized that this perfect microcosm of low interest rates and like big glut of supply with like an increasing amount of demand is happening, you started calling for future demand to come to roost. But let's talk about that statistic that you hung your hat on when you said prices weren't going to drop, which was this months of inventory statistic. Why don't you bring us up to speed on what months of inventory means, and then we can run through these numbers.
Yeah, months of inventory is the best leading indicator for short-term pricing. And what it's measuring is the number of homes that are on the market, meaning available on the multiple listing service. And then we track how many homes sold in the previous month. And just like any business out there, if you're an entrepreneur, if you're a business owner, you look and see how much inventory you have to sell, and then you see what rate things are selling at in the previous month. And that's how you get a pretty good gauge on how pricing is going to look for you in your business. Well, in real estate, it's no different, right? If you have a ton of inventory out there, excess inventory out there, excess supply, and you have very little sales the previous month, you're going to have downward pressure on pricing. And the opposite is true as well. If you have very limited supply, like we have right now, and you have a ton of demand driven by population growth and low interest rates and even future demand that you're pulling forward, right? Then you are going to see upward pressure on pricing. And the coolest thing is that you have these leading indicators, right? And we talk about these things all the time on the show. If you're not tuning into the show every week, you're missing out, right? And especially on these quarterly real estate market updates, because you guys get to see how we are coming up with our ideas as far as where pricing is going. And then you get to see how we are using our company resources to do something about it, to take advantage of it. So if you're constantly trying to see like, where's the smart money going, I share it all with you guys right here. And I share exactly how we come up with this stuff, right? And, we've seen, over and over and over again, that these leading indicators paint a pretty accurate picture about where the market's going. And so we are there again, and we get to share that with you guys again today. And hopefully you guys use that to your advantage to make the best decisions for your investment portfolio.
There you go, man.
And with that,
when you first started sharing months of inventory data, right? It was the first time you mentioned months of inventory was when COVID broke, right? At the time you were like, hey, I know that the news cycle is saying that prices are going to go, take a nosedive, but here are the stats. Average months of inventory in Jacksonville is somewhere in the high 6s, low 7s. Right now we're in the 4s. That means that there is plenty of space before any kind of price drop is going to happen. Too many things are happening right now with supply and demand that mean that at the very least prices are going to stay stable. Little did you know to predict this idea that months of inventory was, and now I'm just going to read out the stats in case someone's listening in the podcast in the near future. It's that by 2019 of September 2019, it was 2.89. September 2020 was 1.79, and now September 2021 is 1.38. So not even 2 months of inventory, not even 1.5 months of inventory. Do you see, is this, this to me is less than 1/5 the average months of inventory, something like that, right? Like max a quarter the average months of inventory. We've had experts on here before saying that maybe there's an actual shift in what the average months of inventory represents, but you look at this figure, 1.38 months of inventory. What does it say to you?
That this is a market where home prices are going to go up in the short run, right? Historically, when you're between 6 to 7 months of inventory, that would be an equilibrium market. Equilibrium does not mean 0% home price appreciation. Equilibrium market means in Jacksonville, 4.3% appreciation is what you would expect, or around right there. So that's 6 to 7 months. If you wanted to see a market that actually is probably poised to decline in prices, you have to get 8, 9, 10, 11 months of inventory on the market to expect a price decline. And I know what a price decline looks like because I was buying and holding investment properties in 2006 and in 2007. And in 2007, December of 2007, we had 18 months of inventory. So I know what that feels like. We had 16,000 houses on the market and we only had 900 sales. We had 18 months of inventory then. So that's what a market that is poised to decline looks like as far as months of inventory. So 6 to 7 months is your barometer. When you see below 6 to 7 months, that's an indication you're going to see higher than normal home price appreciation. And for the better part of the last decade, we have been below 6 months of inventory, and we have seen higher than normal home price appreciation. And it's not a surprise why.
Yeah. Talk about a different scenario, right? Like when 2006 to 2008 was happening and people were talking about how market is overheated and they're seeing something that's going to go down. The MOI was 18 months of inventory. Right now, market is going bonkers. It's going way up. But you look on the other side of it, it's not the same equation, right? Like we are at 1.38 months of inventory, which is a crucial distinction on what the short-term economics are going to be of what you're buying into right now, which at the end of the day, you guys don't include home price appreciation in the actual estimates. But the way that you kind of explain it right now, it's that you're buying it with it somewhat baked in, right? Like at least in the short term, you're going to experience higher than average home price appreciation. And then the rest will depend on how long you hold on to it. Is that how you think about it?
I mean, so let's start with the big picture here. The least most important part of your decision to buy rental properties is short-term pricing. I only go into short-term pricing because you guys ask about it, but I don't make decisions based on short-term pricing, right? The most important decision is a buy and hold strategy for the long haul, for a full market cycle, because that's where things are actually somewhat predictable, right? We talk about how housing is a cyclical pattern, right? Real estate cycles happen. That means patterns happen. That means home prices tend to follow a certain pattern. Well, when you give it a full market cycle, you come back to the norm. The norm in Jacksonville has been 4.3% home price appreciation since 1991. That's been 30 years. So no matter what happens in the short run here, I'm making decisions today, and you should make decisions today based on holding for a full market cycle. And if you do that, you're going to have somewhere around 4.5% home price appreciation on average every year to get there. And so now in the short run, if you guys ask me what I think is going to happen this year to next year, I think home prices are going to go up. And do I think that you are going to have a benefit from that if you listen to what we talk about on the show here and buy your rental properties today and lock in low interest rates? I think you will benefit from that because I think home prices are going to be higher tomorrow, higher 1 year from now than they are today based on what the data is showing. But I don't think you get into this just because you want to capture that, bump on equity. Because long term, what's going to happen is it's going to average out. It's going to be right around 4.5% each year, and that's just the way cycles work.
So let's zoom out, GC. Let's bring up this old familiar chart that we've shown on this show so many times. That's made it so easy for you to talk about how, we're still going up long term, but now we got something new, right? Like we're showing this graph. If you're listening on the podcast, it shows a projected median price averaged out line. That's a pretty steady increase at 4.3% appreciation. And that's in red. And then there's a blue line. This is for you, Greg, because I know you got a problem with colors.
Thank you.
You see it kind of jumping up and down. Right around 2006, you see a big discrepancy above the medium line. That's known as the bubble. Then it drops way back down and it keeps creeping up, going up and down in cycles up until it got right even with this line. And now we're officially above the red line, GC. So talk me through this graph with these new data sets that we have in front of it and how to think about it.
Well, I'm so glad that you guys are here right now talking about this. This might be the most impactful Jacksonville real estate market update we've done because up until now, it's been ho-hum. We have really low months of inventory and we are below the median home projected price trend right here, which is that red line. And when you see both of those things, it's a pretty easy thing for us to look at, all of us as investors, and say, well, we probably think home prices are going up if you understand how those metrics are tracked there. So now what do we see, everybody? We see that the median home sales price in Jacksonville is above the projected median home sales price. What does this mean? Right? Now you need to rely on experts a little bit more here. You need to dig into this a little bit more, because if you're looking at this in a vacuum, you're like, Gregg, if you're saying that overall long term things come back to the normal, if I'm above the median right now, does that mean that it needs to go down to return to the normal? And the answer long term is yes, right? If this works the way that it has worked since whenever we have been tracking real estate values, what you'll see long term is that this average home price appreciation rate will not be as high today, will not be as high in the future as it is today. It will come down to the norm, and that median projected home sales price will meet it. Now, the big differentiator from what you're probably reading in a lot of the headlines is that this does not mean a crash, right? This does not mean that home prices are going to decline, right? I'm sitting here telling you that I think home prices are going to go up from now, right? Especially over next year. What this means, and what normally happens in real estate, is you see lower than normal home price appreciation to get you back to that median projected home sales price. And, that's most likely what is going to happen. Now, of course, we need to monitor this, right? We're going to continue to monitor this, right? We know what we know right now. And right now there's really low supply, right? We know that builders are building. We know that there's still low interest rates, so demand is really high. We know population growth right now is really high in Jacksonville, and that's why we think home prices are still going to go up over the next year. But long term, what's most likely going to happen is that you will see lower than 4.3% home price appreciation. That does not mean zero. That does not mean negative, right? We're going to monitor that. If I start to see things happen that would lead to that, I'm sure going to share it with you. But I do want to make sure people can lean into this data, look at this and say, okay, this is where we are. This is one data point. We need to look at a few other things and know that just because you are above that trend line does not mean that you are going to go below. Just like, in 2016, when we were below the home trend line, I didn't think you were going to shoot up to that trend line the next year, right? The same thing happens. You gradually tend to get back there. And that's most likely what will happen based on the chart that I'm looking at right now.
So I've looked at this chart a bunch of times, and right now I'm looking at it with slightly different eyes, right? Like I'm looking at it in the sense of, okay, what happens now that we're above this red trend line? And I think it's easy to look at this thing and think, okay, well, if I'm above this trend line here and I was above it down here, it's going to look kind of like it did from 2006 to 2011 and just come down precipitously. That's not really the case. It's probably more likely, or I don't know what's more likely, right? But there's options, right? There's the option of this is home price. So it could just kind of go flat for like a little while and the price could stay the same. Homes don't lose value. They just stay completely normal. It could be slightly ascending just at a lesser rate than it's been since it's been catching up to this thing, and hold that for a while. And, home prices, it can return back to the medium of 4.3%. It could also take that precipitous decline. But I think there's also a chance, right? If what's our friend that was with us, that was the real estate expert, that John Burns?
Yeah.
He talked about the idea that months of inventory has reached a new normal, and months of inventory is not going to go back to 6 point something. It's going to normalize somewhere around the fours. There is also the chance that over the next market cycle, there will be a correction in Jacksonville real estate, and it might end up turning into a 5.5% higher than normal home price appreciation with all these tailwinds that are going in and with all these macro changes that have happened to the economy of people moving to better climates and all these other things that are happening, right?
You're 100% right. Right. What we're sharing with you is the best information that we have today. But what we're looking at here is a long-term pricing indicator, right? This is not something that you can say, it's not in a vacuum. For sure, right? We're talking about 10 to 20 year timelines of holding on to rental properties. A lot can change in 10 to 20 years. If you're looking at this and you're saying, well, is Jacksonville more likely to have a higher trend line than 4.3% or a lower trend line than 4.3%. I think you could sit here and say that it's more likely based on the things that you were talking about, Pablo, right? Population growth, right? The world is different today than it was in 2019. And Jacksonville is an affordable market where people are not tethered to their job and can live here and, run on the beach with Pablo and I on Tuesdays and Thursdays, which you can't do in, Sheboygan. So, there's a lot in, the business friendly climate, right? No state income taxes, right? There are a lot of reasons that you could say there would be some sort of shift. But that 4.3% number that I constantly reference it's kind of like a tethering point for me, right? It's going to be somewhere around there. I'm not going to sit here and say it's going to be 4.3%, right? It might be 4.5, it might be 4.1. But think about this, right? In your property evaluations for JWB, we represent 0% home price appreciation, right? If you're thinking about where you're putting your dollars and you think you're going to put it in the stock market, you earn 7 to 9% returns on average over the long haul in the stock market. Well, in rental properties, you earn 7 to 9% without even talking about home price appreciation, right? 7 to 9%, 7 to 9%, right? Then if you just get 4% home price appreciation in rental properties and you use smart debt, right? That pays for itself every single month. And you put 25% down. That's really like you getting a 16% return on investment. So to me, and just from that home price appreciation, so your real return is like 23% in rental properties, right? So to me, I get less, I'm less apt to say, well, is it going to be 4.3 or 4.5 or 4.7 or 4.1? To me, I know it's going to be somewhere around, call it 4% or 4.5%. And when I run the math in my head and I think, well, every point of appreciation I get, I multiply that times 4 because I use debt. That's where it absolutely stands out long-term as being a better investment than the stock market in my mind, right? So did I answer your question well there, Pablo?
Yes, you did. I had myself on mute because I'm on the creakiest chair ever, and I don't want to take the camera focus off of you. But yeah, man, I think you did, and I think it's fair to say 2 things. Number one, if you haven't been with us before, right? So we've got Michael joining us for the first time. Welcome, Michael. If we go over this idea of 4x your return based on just appreciation all the time on the Thursday show. That's the GWB Rental Income Property of the Week, where we actually dissect those numbers, and most of our community is really, really used to that. But that might be tough to follow along if you don't have it in front of you. I recommend you check out one of those episodes or join us the week after Thanksgiving. The other thing, I got 2 more things to say. The other thing is, not only do you not have to live in Sheboygan, you also got to run like a 9-minute mile if you're going to run with us in the morning, just saying. And third of all, right now we're talking about these like really good case scenarios, right? Like we are talking about this idea of an appreciating market, but let's look at this moment right here. If you would have bought right here in 2006, because conveniently we know one person on this call that bought a bunch of properties in 2006, and it's his birthday today. So GC, why don't you kind of run us through these different windows of what it looked like in worst case scenario, and then we're going to jump into some questions that we got piled up in the Q&A before we talk about where it's going and the smart money's heading.
Love it, love it. I'm always trying to think about the questions that our wonderful community asks, and I know most of you tend to listen to what we do here at JWB, and you use our advice, and I appreciate that. And I also really respect folks that may think that I don't know what I'm talking about. And so let's put on our hats of just saying, hey, listen, Gregg is full of it. You don't know what he's talking about. Let's think worst case scenario, how this would have played out if you are in the camp of thinking that pricing is going to go down, and you think that we are going to relive the Great Recession. This message and this slide is for you. Here is what actually happened over the last 10, 15, and 20 year segments of time. And it goes back to this methodology that I preach, which is real estate is cyclical and things come back to the norm when it comes to home price appreciation. Went back and looked it up because, again, I was living this. I owned about 40 rental properties. I bought them in 2006, 2007. I owned those 40 rental properties, and then the market really did crash. So I know what it felt like. For the last 10 years, since 2011, the initial median home sales price, meaning in 2011, was 129.9. Our current median sales price is 308.9. So our average home price appreciation year over year is 9% per year over the last 10 years. Is that pretty good, Pablo?
That's pretty good.
Pablo gives his stamp of approval, right? And we know that our, historically accurate home price appreciation is 4.3%. So we basically doubled that over the last 9 years. Not coincidentally, we had low supply and low months of inventory, which led us to believe that that was going to happen. All right, let's go back again. Let's pick the worst moment that you could have bought rental properties, which was 15 years ago in 2006, which is exactly when this guy bought those rental properties back in the day, right? Our initial median home sales price was actually 199.9. That's not a typo, right? It was 199.9. In 2011, 5 years later, it was 129.9. So in 2006, median home sales price, 199.9. Current median home sales price, 308.9. 2.92% average home price appreciation year over year. I want to say this again. If you bought at the absolute wrong time in Jacksonville and started building your rental property portfolio, if you were that good at timing it, like I was, buying at the wrong time, you still would have enjoyed almost 3% home price appreciation year over year over year. And then if you're using smart debt, multiply that times 4, right? That's 12% that's 12% return on investment just from the home price appreciation, not even talking the cash flow. That's really important data for you all to realize in the value of buying and holding, even if you're just that good that you can buy at the exact wrong time. And lastly there, if you go back a full market cycle, 20 years since 2001, you can see that the average home price appreciation per year over the last 20 years is about 4.8%. So there you go. That's why you see long-term over the last 30 years, we've been about 4.3 or so. It's been about 4.8 over the last 20 years, right? There's a lot that changes. But what the reason why I love real estate and I love rental properties is I just have to get the fundamentals, and then I don't have to care about what short-term pricing does this year or next year. I have to buy and hold, be in for a full market cycle. And there's a really good chance that this is going to play out over the next 20 years.
You see, I don't know what I'm more impressed with, the fact that you perfectly timed the market wrong, or that you bought 40 properties when you were 24. That's, like I'm doing the math. It was 15 years ago, man. You're 24 years old buying 40 properties. Man, that's just so mind blowing to me, man. So, all right, let's get into some of these questions, right? So we now understand that the last 10 years have been phenomenal. The last 15 years have been really, really good for you. And the last 20 years are all you're promising, right? Like just this idea that you know the answers to the test. It's going to be around this kind of level of appreciation. When you compare this to other asset classes, it's hard to beat. So we're going to start, going into what JWB is doing with their money and the rest of the smart money is doing with their money as far as the rental home property equation goes. But for right now, let's dive into some of these questions. And there's a lot of questions on rent pricing here, right? So Drew Barnhill asks, do you have a chart showing a 5-year rent market increase?
I don't have a chart showing a 5-year rent increase. I know some of the data points. What we're seeing across the entire metro is about 8% rent growth year over year. Historically, rent tends to go up with the rate of inflation, and this year is different for inflation, but normal inflation, we tend to think about 3%. So we tend to think of rents going up about 3 to 4% per year. And if I had to venture a guess, it's probably what it was prior to the last year and a half, 2 years ago. And then last year it's been about 8%. And then we've seen that, we've seen as we have re-rented our properties that we've been able to rent those properties again for about 8 to 9% more than the last time they were rented, just with the micro data here at JWB. So yeah, if I had to venture a guess, it'd be over that 4% number just because of the incredible gains over the last year or two. But long-term, you should really plan for that 3 to 4% rent growth as well.
Got it. Denny Davis put an awesome comment here in the chat. And he put, the last 5 minutes were the most important of any show you've ever done. You took the worst case data that you, Gregg, lived and made it real because it was real for you. It's pretty impressive. It's cool.
Danny, thank you so much for that comment. That means a lot. And I just want you guys to know that this is a real thing. Like it's not, pie in the sky theory here. I mean, I was living that. And so that's why I have so much confidence helping you guys make these decisions today that, even in our worst case scenarios, guys, if you believe in this long term and you just stick to the plan, you're going to be okay. It's because that's how I've been.
There you go. GC works hard at putting out those slides, man. I love it, GC. That was a good one. So Drew Barnhill, another question. Do you have a chart for Jack's population growth over the last 3 years? I would imagine that thing looks up and to the right, right?
Yeah, it has. We have been, I believe, the 6th fastest growing MSA, and that was as of 2018. That was even before the COVID effect. I mean, I can't wait to see the population growth over the last 2 years. I don't know when we're going to be able to get that data from the census, but the census came at a time, 2020 census came at a time where you just can't get the full effect of what COVID has meant as far as population growth. So do I have a chart of it? I don't. I know that going into 2018, we were the 6th fastest growing MSA, and then we have seen some of the highest population growth in the post-COVID world. We are now up to 1.6 million people here in Duval County as of last count. And I would expect it would be even higher than that. And, important for you guys to invest in populations where you have at least 1 million people living in that population, because there you have strong economic anchors, Fortune 500 companies, a diverse economy. That's a major milestone for you. And we passed that one a long time ago.
That's interesting that you bring up that data point of 1.6. I always talk about this when I'm always talking about how like surfing is correlated to high property values. I talk about this article that I read when I had just moved to Jacksonville that talked about cities that had more than 1 million inhabitants and over 150 days of surf a year. And it was like Rio de Janeiro, Cape Town, South Africa, Honolulu, San Diego, LA, Sydney, Tel Aviv, and Jacksonville.
Wow,
right?
Really?
And yeah. And at the time it said it was like 1 million inhabitants, and it had Jacksonville right at that 1 million inhabitant mark. Right. So if for me, what's feeling wise, not like number wise, like I feel like early 2018, it was right around 1 million. And now we're like at 1.6 million, which is an insane growth rate.
Yeah. Absolutely.
So, all right, man. Well, enough about surfing. We've talked about that a lot. So Eileen Mateos has a question here. How does the global ongoing construction supply shortage affecting the delivery of JWB's new construction rental properties? How long does it normally take for one townhouse to build? So I guess she's just asking the effect of the ongoing shortage and how that's affected.
That's real. Right. The shortages in both labor and materials is real in construction. It is causing our construction projects to go longer than we want and to cost more than we want. Now, I should point out that cost does not go to you directly, right? The increased construction costs are borne by JWB. And Eileen, I believe, just put a few homes, if I'm not mistaken, under contract. So Eileen, congratulations for being, a JWB client here. When we go under contract with somebody like Eileen, it's a new construction house, and then we get surcharges and lumber surcharges and overages for other materials and labor when it comes to building a house. That's Eileen is protected. She doesn't have to foot that bill. That's JWB's bill. So we do not like the labor supply shortages and the material supply shortages. Obviously, that is counterbalanced by the increase in purchase prices, the increase in the market value as well. So sort of balances itself out for JWB. But it's real. And, when you put a house under contract, it's going to be about 5 to 6 months from the time that you put it under contract, if it's a new construction home, until the time it closes. If it's a renovated home, that's an advantage for renovations, right? You don't have to wait that long. You can close, generally 1 to 2 months after you put it under contract for a renovated home. And so it is causing supply, delays. I mean, you're probably kicking out an extra month, maybe 2 months, because of the myriad of challenges. And, I listen a lot to John Burns, who was a guest on our show probably a month ago. And he did some wonderful work on helping the building industry prepare for the next set of shortages for materials. And so, at JWB, I listen to that, and we take that information, and then we start to say, okay, well, what materials do we need to inventory for our builds next year so that we can have these, appliances, light fixtures, whatever it may be? What can we have access to so that our clients can purchase those homes and not be subject to the whims of course, the supply shortages out there that are coming next year, because it's going to get worse for a lot of supplies. The labor market, we think, is going to get a little bit better, according to John Burns, as we get into 2022 and certainly towards the end of 2022. But supplies are going to be a major issue, and we're preparing for it now so that we can minimize the impact of it.
There you go, GC. I'm going to ask one more question here that's going to dovetail into kind of like where what JWB is doing with their money and where the smart money is going, and then we'll get into the rest of these questions afterwards. So Denny Davis asks, Gregg, if demand sustains and continues to significantly outpace supply for years into the future, meaning we head well above your 4.3 line for a while before correcting back, and price appreciation continues to outpace rent increases for years, how does JWB solve the potential positive cash flow issue for new sales? Seems like an issue that is approaching much faster than previously anticipated for JWB due to unprecedented recent events.
Yeah, Denny, you bring up some really great points there. What Denny's talking about is, as I sit here and say, we expect to see home prices go up over the next 12 months, and we expect to see interest rates go up over the next 12 months as well. We don't expect rents to keep up at the same pace as home prices go up. They will go up, but not as much as home prices in our estimation. What you're creating is a cash flow crunch. Your cap rates get compressed. That means that your cash flows, in theory, could become negative for the same exact properties that you're buying today. And I think that's a real thing, guys. I don't know that when that will come into play, but I want everybody to heed that message that positive cash flow is not a right. When I was buying properties back in the day, it was really, really hard to find positive cash flow properties. And that's when myself, Alex, my business partners, and I were pounding the payments, spending 70, 80 hours a week, busting our tails to go out there and find properties. What we're trying to create for all of you out there is a very passive investment for you. And so, positive cash flow is not a right. It's not normal, right? And I don't have a big solution for you for that, right? This asset class is going to become less attractive for returns in future years. Now, the caveat to that is that this asset class, as I just talked about, especially when you factor in all 5 profit centers, is so much more attractive than other asset classes right now that it can afford to be a little bit less attractive as far as returns on investment in future years, and still probably be a viable asset for you in your portfolio. But I don't have a big answer for you there. I know we are committed to doing whatever we can to preserve cash flows. And so you've seen us roll things out this past year that limit maintenance costs, limit vacancy costs. We are committed to trying to have your residents stay as long as possible. And the reason that we do that and we sign those long-term leases is because that's going to decrease your tenant placement fees. That's going to decrease the maintenance costs because you're going to have less turnovers. We implemented a septic warranty program. Septic costs were one of the biggest cost drivers for clients. Sometimes it costs $6,000, $8,000, $10,000 to replace a septic tank and a drain field. And so we said, well, how can we mitigate that big cost driver? And in this year, 2021, we rolled out our septic warranty program. So for anybody who buys a new construction property or a renovated property that has a new septic system put in, that's under warranty. You don't even have to pay for that warranty. Your resident picks up the warranty for you. And if that septic tank and that drain field go out, well, it's replaced for you, and it's not an additional cost for you. So we are absolutely committed to doing those things to mitigate what is happening, which is that cash flows are going down as home prices go up, interest rates go up. And so you should use this advice. If you are thinking about buying a rental property, you should pull that demand forward. You should do it now, because I really believe that cash flows and returns long-term are going to be less than they are as we sit here today.
So as you say this, GC, I think of two things. I think of number one, those cash flows will reduce for people buying them in the future. People buying them now, cash flows are going to stay the same / increase because of debt pay down, right? Which is why you're saying to pull the demand forward. Two, I also think this is more of a business model question for JWB, right? Like this is just like, what are you guys going to do when there's no more, positive cash flow? What are you going to be selling? And I think you're talking about the short-term stuff that you're doing for rental property investors, but something you're not talking about right now is this idea that you have this like R&D arm that's developing multifamily and doing a bunch of big neighborhood plays that are going to preserve the longevity of the company and the ability to deliver other assets to the class that you're going to have flexibility of getting into. And then I'll also think as a customer, right? If I'm just thinking, man, is this company going to be around for 20 years? I also think of the fact that you're basically the biggest, one of, if not the biggest single home property management business in the United States of America. So like, if you're thinking about it as far as longevity of our lights going to still be running with JWB, don't forget about this idea that, yeah, they may not always be selling single family homes. You're also going to be managing properties and doing all that because you're profitable in doing that as well, because you have changed that business model for people. So without further ado, I just kind of want to show what you are doing right now in the rental home property kind of investing space and provide this company update that you have of just exactly, what your activities are. And that basically shows a trend of homes being purchased going dramatically, going up a little bit from 2019 to 2020 to dramatically up in 2021. New construction homes started going way up from 2020 to 2021. Renovations complete seem to have gone a little bit down. I think you've talked about this before, how it's harder to find properties to flip because of high demand. And then the turnkey property sales have also dramatically increased year over year. You want to kind of take us through this slide and what JWB is thinking here?
I do. And before I go into this, though, I think your analysis of how we are preparing our business to withstand those market changes that Denny was talking about is very real. With one caveat, we're going to be here to sell turnkey rental properties. Even as cash flows are lower in the future than what they are today, we're fully expecting that our hedgehog is not going to change. And it's just simply because when you compare the return on investment for rental properties, even if cash flows go to zero, you compare that to the other options that people have with their money, with a little bit of education and with a whole lot of mind-blowing customer service, rental properties are going to stand out to other folks and be a viable option. That's something that I'm very, very convinced of going forward. So we're going to be here doing that. And then the property management part of it, you're right. Like this is the reason that we started to take on outside property management and offer to do property management for clients that did not purchase properties from us. We started to do that probably 4 years ago, 5 years ago, is because we were thinking ahead. We said, listen, what happens if turnkey rental properties, if something changes? We saw that prices were going to go up, right? We looked at that same chart that I showed you guys, and we thought that prices are going to go up. And we said, well, we want to be a company that can be here no matter what the real estate market throws at us. And if you're a real estate developer, cash flows, internal cash flows for real estate developer are typically the hardest thing to manage because it's feast or famine based on projects for real estate developers, right? We said to ourselves, listen, we need to grow our property management business because that's our risk mitigator, right? How cool would it be if JWB can continue to operate and serve our clients, even if we didn't have to actually sell any properties, right? We run that metric. It's not because I don't want to sell properties to all of you out there. It's just that, hey, listen, what if the market throws this at us that our sales decreased by 50%? Well, we thought about this a long time ago, and that's why you've seen our number of properties under management go up so much in recent years. We're over 4,500 homes that we manage now. When we made that decision, we were at about 1,500 homes. You're going to see us continue to grow that property management angle because, if the things that would happen for our turnkey sales to go down, if the market would throw that at us, that would position us really, really well to be the solution on the property management side, and that segment of the business would grow. So we're not going to go anywhere. And I don't think turnkey rental properties will in some fashion or form or fashion as well.
All right. I appreciate the correction, GC. My bad on sleeping on that one. Go ahead. Tell us about what you're doing right now.
And this is just us. I wanted to show you what we're doing inside the walls here. This is, I want to make the connection from the data to how we act. And then we're going to see as we wrap up the show, how the bigger guys, the even bigger guys are acting as well. And they're all following similar data paths to how they're acting here. This is us living out our truth right here. In 2021, we see that we are above that trend line, and we are on pace to purchase about 1,000 properties. And I can tell you that's our plan going into 2022 as well. How much can we gobble up, right? Even though I just sat here and told you that we're above that trend line. And it's because we think, number one, the most important thing is long-term value in this asset class. Buying and holding for the long haul is going to be the play, and it's the play for us as well. It's a play for our clients, and you can see that there in homes purchased. And you hit the nail on the head. We are very big in new construction right now because that's what the market is throwing at us, right? Existing inventory is very hard to come by. We love renovations, just like we love new homes and new construction, but there's just not that many opportunities. So that's why you're seeing the number of renovations completed go down, and you're seeing a huge jump in turnkey property sales. Again, huge demand for this asset because of the same things we've been talking about for this entire hour.
There you go. So JWB is not excluded from wanting this asset as well. You are putting your money where your mouth is, and what you're telling people to do. You're gobbling up this stuff too. You're building more lots. You believe in this thing. Let's see what the big boys are doing. If you don't count as a big boy, which I think you are now that you're 39, but what are the bigger boys doing?
Well, for all of you who joined us for John Burns being on the show, which was a huge treat. I mean, I can't tell you it's just really tough to get John on a show. Let me just say that, right? John's time is very valuable. He's out there talking to the Wall Street Journal and New York Times and being quoted and all that good stuff. So super happy that he was on the show with us. What he shared in his research is he's actually gone and seen what the big guys are doing with their money, right? Don't they always say, follow the money? What are the big guys doing? Follow the money. Right. Well, the big guys and the big ladies out there are spending a lot of money to get into this space, and they are coming here for the first time. Right. There's $30 billion coming to this space just in the last year and a half. And I know this slide, you can't read some of these names. So I wanted to share some of these names with you. You'll recognize some of them. Again, 30 billion coming into this space. You've got Pacific Life Insurance and Tricon Residential putting a partnership together with $300 million in equity that they're going to turn into $1.5 billion of capitalization through the use of debt. And they're going to be buying and building 5,000 new single-family rental properties. KKR is now buying and managing rentals nationwide. JP Morgan Chase and American Homes for Rent are partnering up $625 million to buy 2,500 single-family rentals. That's happening right now. And they are looking at the same data that I'm sharing with you. And the question you should be asking yourself is why? Why is this big money that has never been in this space before all running here right now? And what can you use to make the best decision for yourself? So here's some of the articles here. You can see this, right? Just do a few Google searches. Google some of these headlines right here. Tricon, Pacific Life, JP Morgan Chase, KKR. I took those headlines for you right there. You can Google John Burns, $30 billion coming to the space. You'll see all of these companies, right? And Pablo, let's go to the last slide there, because that's how we're going to wrap it up, right? Why are these companies saying, I could do anything with my money? Historically, I've never put my money in single family rental properties. I've never partnered with, companies like American Homes for Rent or Tricon Residential and or Lennar and some of these big builders. I've never, if I'm a big hedge fund, I've never put my money in single family. Why am I going to do that now? And here's why. It's because there are other opportunities to put that money in place are not as good, right? They have determined is the best risk-adjusted return on investment today. And that's why they are coming in at record paces, right? Think about what they typically would invest this in. Single family rental properties is typically compared to bonds. That's an alternative investment. It's a conservative investment that has recurring income. Worldwide bond yields are at historic lows. If you haven't been paying attention to that, investors need yields and they are not getting them from bonds. Inflation, right? Inflation is the major talking point right now. Whether you think it's transitory or not, it is real right now. Consumer price index is over 6% for the first time in I don't know how long. We're all feeling that. And investors view rental homes as a hedge against inflation. You're seeing record high rent growth, and that's also supported by high occupancy. You've got both of those things working right now. And now this is the big kicker, right? The big money saw this as an opportunity for a long time. Well, I won't say a long time, right? Really kind of the last year or two. But they didn't jump in right off the bat. It's because they wanted this model to be proved out. And they wanted to see that renters were willing to pay a premium to rent a new home in a new neighborhood and be managed by a professional landlord. That had never really been done before, single family rental communities. And so they wanted to see this proved out, and they've seen this proved out over the last year, 2 years. And what they're seeing is that residents are reporting a better renting experience, right? You don't have your typical mom and pop landlord anymore. You have a professional management team, and residents are preferring this because now they can make better life decisions to stay in that rental home if they want to for a long period of time, rather than saying, oh, geez, my landlord might want to sell next year. I might have to uproot my family and change everything. So there's a lot of advantages here. And once they saw that the end user, the consumer, is fully bought in, the big money has been just rushing into this space. So my question to all of you is, you're seeing what JWB is doing based on this data. You're seeing what the big guys are doing out there. What are you going to do to take advantage of this overwhelming data and this overwhelming qualitative information that's being presented to you?
You see, as you say all this stuff, man, to me, the answer to your question is obvious. I guess the only thing that would freak me out is if all this money is running into this space, and I want to follow suit. You keep talking about waiting lists and undersupplied markets with a ridiculous amount of demand. How reasonable is it for an investor that today is just like, oh my God, I just saw this update. I got to take my money out of my 401k and buy some properties with it. I got to take my money out of the stock market, buy some properties with it. I got to take money out of, whatever other gold and buy some properties with it. How reasonable is it to believe that you could move into this market class without missing this window right now?
Well, that answer varies greatly depending on who you're doing business with. The general landscape right now, and the reason why this money is moving in so fast right now, is because they are trying to gobble up the limited amount of inventory that there is out there. And if you're an investor and you've been trying to buy properties, you're probably met with a lot of waiting lists or a lot of delays as far as you actually acquiring the property yourself, putting in offers, getting rejected. You know how it goes. So how easy is it? In the general landscape, it's not easy. But obviously, JWB thinks about this, right? We positioned ourselves to be that solution when it's really challenging for others. So there's no waiting list for clients that want to be purchasing properties today with JWB. I was just looking at last week, we had 2 or 3 clients that purchased 3 or 4 homes and started their portfolio just like that, pulled money from the stock market, pulled that demand forward that they were thinking about buying rental properties over the next few years, and now have a portfolio of 3 or 4 properties. There's no restrictions right now for JWB. And I got to tell you, like that sounds really great, but let's put this into financial terms. Waiting lists right now in an environment where home prices are going up and interest rates are going up are really costly to you, right? 1 year ago, I said this was the best time to be buying rental properties. Home prices, let's just say they went up 20%. It was 15 to 20% depending on the month, right? For a property that costs $200,000, that's adding $40,000 to your purchase price. I mean, that's real numbers, right? We expect home prices to go up faster than the historical average next year. Let's call it 5%, right? That's another, call it 10 grand, 15 grand of cost next year that if you act now, you would have been saving. So the challenge is some people don't know that they want to make the decision. I totally respect that. But then the real challenge is when they make the decision they want to do it, they get met with waiting lists. And that's really, really costly. Going on a waiting list, what the typical experience is, you have to wait 9 to 12 months for another company to secure the asset for you. They take a deposit from you. It might be $1,000. It might be $5,000. They sit on your money for $1,000 or $5,000. They go and they build that house. But they also have cost escalators along the way. So you sign up and your prices go up and up and up the longer that it takes. You also can't lock in your interest rate. So if interest rates go up in 3 months, 6 months, 9 months, they go up twice, you really have no ability to act on it. So, JWB has inventory right now, as I mentioned, no waiting list. And then the other thing is when clients put their homes under contract, that price is set. If home prices go up another 5% or 10% over the next 6 months, those home prices are set. You walk in with instant equity, which is a little bit different. So than what else is out there. So it is easy for JWB. All of you can take advantage of it now. And it starts by talking to my team and making sure this is a great fit. And outside of JWB, it's really tough.
So short answer is go to chatwithjwb.com and you can do it. If you don't, it's going to be dicey. Right?
I think so.
Listen, GC, we've gone way over here on time. It's your birthday. We got a ton of questions. Number one, I want to express a huge, huge gratitude to our community. We're going to do that in a second. But before everybody logs off, I'm going to give you a birthday present. Of all the Q&A that's left, you're going to go into the Facebook group and you're going to answer it over the next couple of days. All right, buddy?
Love it.
Is that good? Right. So we're downloading the Q&A that's left over. GC is going to go in the Facebook group. If you're not part of our Facebook group, it's a community of over 3,000 investors just like you that do what we're doing here today. Exchange ideas, help each other out, do all that stuff. So go join. That's you, Michael Kabuta, who I see that's new. I haven't seen you in there. It's going to be great for you. Hope to have you back as well. Anybody else that's joining us for the first time. Second, it's Thanksgiving. Man, I could not be any more grateful for the experience that this has been over the last 2 years, putting this show on with you, GC, putting this show on in front of our amazing Not Your Average Investor Show community, you sharing, the clientele that is a part of your network and the people that are trying to learn about this. This is an unbelievable group of people that I'm extremely, extremely grateful to be a part of and to be able to do this every week with you, man. I'm grateful for your friendship and your influence in my life. And I just want to throw that out there on this Thanksgiving week that, we don't take it for granted that you spend an hour of your day here on the Not Your Average Investor Show on Tuesdays and Thursdays. And we're going to continue to bring as much value as possible because there's nothing that I like more, nothing that's more important to me, man. So I'll give you last words.
Well, I'm going to start with our community and just thank you guys. I appreciate all of the love and the support, and you guys say so many wonderful things. I get to see some of the chats coming through here, and Denny's comment really hit me. And I see Lee's comments and saying that we did a great job and all that. And we put a lot of heart and soul into the show, but you guys give us so much more than we ever could put in. You guys showing up, and this community that has become a real thing that is now meeting together in parts of all across the country and coming together is a real thing. It's a real gift. And I'm just so thankful. I never expected to be a part of a community like this that we have created together. So I'm very, very thankful for this. Thank you all for the birthday wishes. Pablo, thank you, brother. It's been an awesome journey here. It's almost 2 years in the book since we started this thing. And, I'm even more excited for next year and the many years to come on the Not Your Average Investor Show. Thank you, everybody.
Happy Thanksgiving, y'all. Happy birthday, GC.